Retirement is a dream for many people, but it can also be a challenge. How do you know how much money you need to retire comfortably? How do you save enough for retirement without sacrificing your current lifestyle? How do you plan for the unexpected expenses and risks that may arise in your golden years? These are some of the questions that many people struggle with when it comes to retirement planning. In this article, we will try to answer them in a simple and practical way. We will also give you some tips and tricks on how to save for retirement and how to make your money last longer. How much money do you need to retire comfortably? The first step in retirement planning is to figure out how much money you need to retire comfortably. This depends on several factors, such as your desired retirement age, your expected lifespan, your desired retirement lifestyle, your expected retirement income sources, your expected retirement expenses, your expected inflation rate, your expected rate of return on your investments. One way to estimate how much money you need to retire comfortably is to use the 4% rule. This is a rule of thumb that says you can withdraw 4% of your retirement portfolio in the first year of retirement and then adjust that amount for inflation every year. This way you have a high chance of not running out of money for at least 30 years. For example, if you have a retirement portfolio of $1,000, you can withdraw $40,000 in the first year of retirement and then increase that amount by the inflation rate every year. If the inflation rate is 2%, you can withdraw $4,800 in the second year, $41,616 in the third year, and so on. To use the 4% rule, you need to know how much money you need to spend every year in retirement. This is your retirement budget. You can estimate your retirement budget by looking at your current expenses and adjusting them for your retirement lifestyle. For example, you may spend less on transportation, clothing, and taxes, but more on healthcare, travel, and hobbies. Once you have your retirement budget, you can multiply it by 25 to get the amount of money you need to retire comfortably. This is based on the 4% rule, which is equivalent to dividing by 0.004. For example, if you need $50,000 per year to live comfortably in retirement, you need $50,000 x $25 each, one on $250,000 to retire comfortably. Of course, the 4% rule is not a perfect formula. It is based on historical data and assumptions that may not hold true in the future. It also does not account for the variability of returns, taxes, fees, and other factors that may affect your retirement income and expenses. Therefore, you should use the 4% rule as a starting point, but not as a definitive answer. How to save for retirement. The next step in retirement planning is to figure out how to save for retirement. This depends on several factors, such as your current age, your current income, your current savings, your current debt, your retirement savings goals, your retirement savings options. One way to save for retirement is to use the pay yourself first method. This is a method that says you should save a certain percentage of your income for retirement before you spend it on anything else. This way you make saving for retirement a priority and a habit. For example, if you earn $60,000 per year, you can save 10% of your income for retirement, which is $6,000 per year or $500 per month. You can set up an automatic transfer from your checking account to your retirement account every month so you don't have to think about it. This way you save $6,000 per year for retirement without affecting your lifestyle. To use the pay yourself first method, you need to know how much money you need to save for retirement. This is your retirement savings goal. You can estimate your retirement savings goal by using the 4% rule, as explained above, or by using a retirement calculator. Once you have your retirement savings goal, you can divide it by the number of years you have left until retirement to get the amount of money you need to save per year. For example, if you need $1,250,000 to retire comfortably, and you have 20 years left until retirement, you need to save $1,250,000, $62,500 per year. Of course, the pay-yourself-first method is not a perfect method. It does not account for the compounding of returns, taxes, fees, and other factors that may affect your retirement savings. Therefore, you should use the pay-yourself-first method as a guideline, but not as a rule. How to invest for retirement. The final step in retirement planning is to figure out how to invest for retirement. This depends on several factors, such as your risk tolerance, your time horizon, your asset allocation, your diversification, your rebalancing, your fees. One way to invest for retirement is to use the asset allocation method. This is a method that says you should invest your money in different types of assets, such as stocks, bonds, cash, and others according to your risk tolerance and time horizon. This way you can balance the risk and return of your portfolio and reduce the impact of market fluctuations. For example, if you are young and have a long time horizon, you can invest more in stocks, which have higher risk but higher return potential. If you are older and have a short time horizon, you can invest more in bonds, which have lower risk but lower return potential. A common rule of thumb is to subtract your age from 100 to get the percentage of your portfolio that should be in stocks. For example, if you are 40 years old, you can invest 100, 40, 60% of your portfolio in stocks, and the rest in bonds and cash. To use the asset allocation method, you need to know how to choose the right assets for your portfolio. This is your asset selection. You can select your assets by using a retirement fund, such as a target date fund, a balanced fund, or an index fund, or by creating your own portfolio of individual stocks, bonds, and other securities. A retirement fund is a type of mutual fund or exchange-traded fund, ETF, that invests your money in a diversified portfolio of assets according to your retirement date or risk level. For example, a target date fund is a fund that adjusts its asset allocation from more aggressive to more conservative as you approach your retirement date. A balanced fund is a fund that maintains a fixed asset allocation of stocks and bonds, usually 60-40 or 50-50. An index fund is a fund that tracks the performance of a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. A retirement fund is a convenient and low-cost way to invest for retirement, as it offers professional management, diversification, and automatic rebalancing. However, a retirement fund may not suit your personal preferences, goals, and circumstances. Therefore, you should compare different retirement funds and choose the one that best matches your needs. Alternatively, you can create your own portfolio of individual stocks, bonds, and other securities. This gives you more control and flexibility over your investment decisions, but it also requires more time, knowledge, and effort. You also need to pay attention to diversification, rebalancing, and fees. Diversification is the practice of spreading your money across different types of assets, sectors, industries, countries, and companies to reduce the risk of losing money due to a single event or factor. For example, if you invest all your money in one company and that company goes bankrupt, you lose all your money. But if you invest your money in many different companies and one of them goes bankrupt, you only lose a small portion of your money. Rebalancing is the practice of adjusting your portfolio periodically to maintain your desired asset allocation and risk level. For example, if you start with a 60-40 portfolio of stocks and bonds and the stock market rises, your portfolio may become 70-30. This means your portfolio is now more risky than you intended. To restore your original asset allocation and risk level, you need to sell some stocks and buy some bonds. Fees are the costs of investing, such as commissions, spreads, expense ratios, management fees, and others. Fees can eat into your returns and reduce your retirement savings. Therefore, you should look for low-fee or no-fee investment options, such as discount brokers, online platforms, and low-cost funds. Of course, the asset allocation method is not a perfect method. It does not guarantee that you will achieve your retirement goals or avoid losses. It also does not account for the changing market conditions, tax implications, and personal circumstances that may affect your investment decisions. Therefore, you should use the asset allocation method as a framework, but not as a formula. Conclusion: retirement planning is a complex and important process that requires careful thought and action. In this article, we have tried to simplify it by explaining how to save for retirement and how much you need to retire comfortably and how to invest for retirement. We have also given you some general guidelines and rules of thumb that you can use to plan your retirement. However, you should remember that these are not universal or definitive answers. Your retirement planning depends on your personal situation, goals, preferences, and circumstances, which may change over time. Therefore, you should review and update your retirement plan regularly and seek professional advice if needed.